Hello, here we go with another clip. What are we, clip 4, I believe. Yes, we're at clip 4, chapter 2, clip 4, which are include slides 28 through 36. So let's look at some special equity instruments. Special equity instruments. All right, the first would be warrants. Warrants. These things are traded. You can see them out there. You can buy them and sell them if you want. A warrant is issued by a corporation. It gives the holder the right, but not the obligation, so you can do it if you want to, but you don't have to buy a specified number of shares of stock within a specified time period at a specified price. So it's a contract that says you can buy 100 shares of this stock at $50 a share. Okay? And they are often attached to a new issue of bonds or stocks. Okay? And the issuer does this as an enticement, what we call a sweetener, for investors to buy the new issue. Hey, how can we increase the demand or the interest in our bond or stock issue? Well, let's attach a warrant to it. Okay? A close relative of the warrant is the option. Options. Now, options are a little bit different from warrants. Like a warrant, it's a contract, and it gives the buyer or holder the right to buy or sell a certain number of shares of stock. So a warrant, you can't sell, you just buy stock. There are options that give you the right to buy and options that give you the right to sell a number of shares of stock at a certain price within a certain time period. Okay? Whoops. Let's get the animation right. Unlike warrants, options are not issued by corporations. Remember, warrants are issued by corporations, but options are not. But they're issued by investors who are willing to transact in the stock underlying the options if that is necessary. And actually, investors don't issue options anymore. Exchanges, option markets issue standard options contracts. Okay? So if an option holder, someone who owns an option, decides to use the option to buy or sell the stock, this is called exercising an option. Exercising an option. So sometimes people buy options, they are betting, gambling, or speculating that the price of the underlying stock will go up and the value of the option contract itself will go up. They don't intend to buy the stock or exercise the option. They are just trying to make a profit, and they make a better profit on the options contract, a higher return than they do on the stock price. Okay? We'll get into more detail later in the semester about options, but warrants usually are very long term. They usually have a time period that extends out over 5 years, whereas options typically are much shorter term. Their contract term less than a year, usually a year or less. All right, a little more detail about option. We have call options. What is a call option? This provides a right, but not the obligation, to buy a stock. So the owners, the people who buy call options, expect and hope that the stock price will rise. Therefore, the price of the option contract will rise as well. And in percentage terms, if you buy the option instead of the stock, you'll make a much higher percentage rate of return than if on the option than you will on the stock. Then you have a put option, and this gives the holder the right but not the obligation to sell a specified number of shares at a specified price within a specified time period. And the owner of puts expect the stock price to decline. So if you think that a stock price will go up, you buy a call option. If you think the stock price will go down and you want to profit from the decline, not the rise, but you want to profit from the decline in a stock price, then one of your alternatives is to buy a put option. The put option will go up in price when the stock price goes down. Okay? So you can make money on stocks when they go up and you can make money on stocks when they go down. Some of you might not have known that. All right, and there's another technique called shorting that we'll look at in another chapter that is also a way to make money when a stock price goes down. Okay, options are considered a depreciating or a wasting asset in terms of time, okay? Because the time period covered by an option is relatively short, 1 hour to 1 year, so investors don't have much time to recover if they're wrong about the stock. An option contract has a limited time frame, and when that time is over, the contract becomes worthless. With a stock, you can buy it and hold it forever, and you may think it's going to go up, and it goes down for 6 months, and 2 years later, it's at a price. The stock is at a price that's higher than what you paid for it. Good for you, but when you're buying an option, you have to be right on the direction of the movement of the stock and the movement of the option price, and you must be correct on the timing. Okay? So the direction of the price movement, the magnitude of the price movement, and the timing of the price movement, you have to be right on all 3 counts when you buy an option. All right, now let's look at futures. Futures. Again, similar to warrants, similar to options. A future is an agreement that provides for an exchange of a specified asset at a specified price by a particular date or on a particular date. And so typically these 2 parties get together and they agree on how much is going to be transacted and at what price, and a good faith payment, usually 10%, is required. The seller of the option requires a 10% down payment from the buyer of the future. I said option, but I meant future. Okay. If you think that an asset price will rise, then you buy a contract. If you think that an asset price will fall, then you sell a contract. Okay? So let's look at an example. Futures are used by owners of assets, people who own businesses that produce assets like agricultural products and energy products, okay? Steel products, lumber products, things like that. Users, and by users of assets to control the price risk. So the purpose of a future is to lock in a quantity of an asset and the price of an asset for both suppliers of the asset and users of the asset. Let's take the price risk or the price uncertainty out of the mix. All right, for example, a corn farmer may want to lock in the current high price of corn. So maybe you've got 1,000 acres of corn and it's going to produce, let's say, 10,000 bushels of corn. And you look out there in the marketplace and you see that corn is trading at an all-time high, and you're talking to the U.S. Department of Agriculture and they're saying the weather's great and more land has been cultivated for corn than in the last 10 years, and the corn is going to be coming to market in the next 6 months, and if the supply goes up, then the price is probably going to go down, and right now you're at an all-time high, so you go out there and you sell. If you're the owner of the corn, you might sell a contract and try to lock the price in because you're afraid the price might go down, okay? You sell a contract. Alternatively, an airline company might lock in the low price of jet fuel, okay? Maybe oil prices, maybe OPEC announced that they're going to increase production and oil prices fall, and Southwest Airlines or Delta Airlines says, hey, oil, jet fuel is a huge component of our cost structure. Let's go ahead. Oil prices are low right now compared to where they have been. They may go lower, but let's take the price risk out of it, and let's hedge or cover half of our needs going forward for the next 3 years. Let's go ahead and lock it in. At least we know what our prices are going to be, what our costs are going to be. Okay? All right. As with an option, you have leverage when you're working with a future. What does that mean? That means a small amount of money out of your pocket controls a whole lot of assets. That's what leverage is. Leverage means your equity is low because you basically have borrowed money. Okay? Unlike options, when you buy an option, the amount that you have put at risk is the amount that you paid for the option. If the option price goes up or down, the value of the option goes up or down, but you don't have to put any more money in. Not true with the future, okay? Not true with the future. If the value of the underlying asset, the oil, the jet fuel, the corn, if the price of the asset changes, you might have to come up with additional money, okay? So be careful with futures. The additional money is a good faith gesture to show that you are able to pay for the asset they are buying or deliver the asset that is being sold. Okay, so once again, a contract is a promise made by the buyer and by the seller, and it's only as good as the honesty and the integrity of both parties. Okay, you can buy futures on lots of different things, including all sorts of agricultural and energy commodities and gold commodities, things like that. You can buy futures on U.S. government bonds to lock in interest rates. You can buy futures on the S&P 500. Lots of different equity investments can be purchased with options and futures. Options and futures. All right, lastly, let's look at a special equity instrument that has become very popular in the last 10 years, exchange-traded funds. Exchange-traded funds. All right. Like American Depository Receipts, exchange-traded funds are single units, they're certificates that represent a basket of stocks. Well, I use Nestle as an example. An ADR, a Nestle ADR, is a certificate that says the bank owns 100 shares of Nestle, and now you own the certificate, which means you own the 100 shares. With an exchange-traded funds, it's a certificate of ownership, but it's ownership of several different securities. It could be bonds, it could be stocks, okay? But not just one stock, but the stock of lots of different companies in there, okay? They are primarily traded on the American Stock Exchange, and we'll get into the different exchanges, okay? And there are exchange-traded funds for almost all of the major stock indexes, okay? So you want to invest in an index, you can do it through exchange-traded funds. There are exchange-traded funds for a wide variety of economic sectors. You want to own the healthcare sector, there's an exchange-traded fund, let's call it an ETF, for healthcare, for technology. Every single industry, every single economic sector, every single country, every single region has an ETF. Okay? So you can buy an ETF. Instead of trying to buy individual securities in these areas, you can own the whole area. Okay? Through ETFs. Let's see, I think we're good. All right, just want to make sure that we get your all of your blanks filled in. All right, like mutual funds, ETFs provide instant diversification with one transaction. You just buy one ETF and you're instantly diversified, depending on, you may not be diversified adequately, because if you buy a computer technology ETF, you will get a lot of computer technology stocks in that ETF, but you will not diversify outside of the computer technology sector. Okay? Like stocks, they can be traded any time that the exchanges are open. So you buy and sell right there. When you put your order in, your order gets filled. And like stocks, you pay a commission to buy and sell those ETFs. Okay? And like a mutual fund, while there is a management fee, every ETF is issued by a company that manages that ETF, and they take a fee out of the ETF, okay, that comes out of your value. So you're paying a fee. Okay? So you'll pay two fees. One is a commission to get in and out of the ETF, and two is the management fee, very similar to a mutual fund. And we'll go over this in more detail in another chapter. All right? Like an index mutual fund, the fees are very low. The management fees for ETFs are very, very low. Okay, that's good news. All right, so we're finished with special equity instruments. We're finished with equities. We're finished with bonds. And we're going to move into investment companies, which is another term for mutual funds, and we'll do that in the next clip. Until then, love you, peace out, shalom.